All right, guys. It's still uploading. I'm not sure if I'm live yet or not, but if you can hear me, let me know inside the chat. Just make sure we're all good on the technical front right off the bat. And feel free, guys, too, as we go through these presentations and this presentation especially, feel free to jump in, say hi, let us know that you're there. We always love some interaction. If there's any questions on stuff that I'm talking about today, just let me know, okay? I'm going to be jumping back and forth between a screen sharing presentation and trying to draw some stuff out on the whiteboard for you guys. And hopefully by the end of this, you guys will have a complete understanding of how Social Security is taxed and how you can use it to save on taxes as well. So let me just screen share here. Everything should be good. Let me refresh and make sure I'm live in the group, and then we'll go ahead and get started. Awesome. Thanks, Bruce. Appreciate it. Awesome. So we'll go ahead and get started right off the bat here. And today we're talking about the tax saving secrets around Social Security and why Social Security may be one of retirement's best kept tax saving secrets. And the reason I say it's a best kept tax saving secret, it's a little bit of a hyperbole, but the reason I say it's a best kept secret is because Social Security is so confusing and such a complex system that most people undervalue what I feel are the most important parts of Social Security. They look just at, what kind of benefit they can get each month. And by doing so, they leave a ton of money on the table by not thinking about their benefit through this tax lens. Now, as I said in the description for this presentation, not everybody is on an equal playing field when it comes to taxes. And what I mean by that is innately Social Security has some tax benefits to it. Okay. But those who understand the system and use strategies and different techniques to get the most out of Social Security will end up saving more on taxes than the average layperson. Okay. So let's get into this and talk about how you can save on taxes. And right off the start here, a couple of years ago, or a couple of decades ago, I believe, Stanford did a marshmallow experiment. Okay. And this marshmallow experiment was, they basically took a bunch of kids from the ages, I believe like 3 to 6, and they put them in a room and they basically told them, okay, we're going to put a marshmallow in front of you. Okay. And if you can eat the marshmallow as soon as you want, but if you wait 15 minutes, okay, and don't touch the marshmallow, we'll give you 2 marshmallows. Okay, and so it was kind of this experiment with delayed gratification. It was done with kids to see if, this delayed gratification is something that we learn or something that we're innately born with. And interestingly enough, the researchers left, and as you'd expect with most kids, they saw this marshmallow in front of them and squirmed. It was almost impossible for them to wait for the 15 minutes. And so, as you can see in this picture, he's holding his head. He's having trouble delaying that gratification and ends up eating this marshmallow. And so a huge number of these children ended up eating the marshmallow and getting that gratification right away, foregoing the 2 marshmallows they could have had by waiting just a little longer. Interestingly enough, they tracked these kids through college, through high school, through college, and across the board, the kids that were able to delay gratification and get the 2 marshmallows, they were able basically to stick with that throughout their life. They did better in sports. They did better. They had better grades. They had better jobs. And so this delayed gratification concept of just waiting a little bit longer ended up benefiting them throughout their life. And obviously, we all know how beneficial delaying some gratification can be. But how does this factor into Social Security? Okay. Well, a big part of getting the most out of Social Security and having some significant tax savings with Social Security will involve delaying your benefit to an extent, delaying the time at which you can file. You can file as early as 62 or as late as 70. Okay. And to get the most tax benefit from Social Security, it will involve delaying. Now, many people look at this as, if I retire at 62 and I delay Social Security, I'm going to have to fund my retirement through my savings, and that's really going to hurt my savings. Okay. And what I want to show you in this presentation is that delaying your benefit not only helps you for the rest of your life, 70 and beyond, but also it's not as much as a sacrifice as you think. Okay. And even if it is a sacrifice, taking that sacrifice and delaying filing for your benefit, filing later into retirement, I'm going to show you how you can get essentially 2 marshmallows. So as a retiree, kind of from the start, just kind of an interesting question right off the bat is, are you going to be a 1 or 2 marshmallow retiree? Are you going to be someone who, is going to retire at 62 and immediately file for their benefit, or as soon as you retire, file for your benefit? Or are you willing to delay filing, take a little bit of a hit from your retirement savings in order to benefit yourself for the next 20, 30 years to come? Okay. 2. Yes. Bruce, thank you. Yes. Be a 2 marshmallow retiree. Okay. So we talk about this every time in our presentation. We're talking about it again today. What's going to be your largest expense in retirement is taxes. And so if there's one expense that we can cut down on to make a huge difference in our retirement picture, cutting down on taxes is a great way to start. The reason I always have an asterisk there is if you have a substantial amount of retirement savings and you have a low income need, okay, investment fees might actually be your largest expense. But for this discussion today, we're going to be talking about taxes. Okay. So because taxes are your number 1 largest expense, and because we know they're actually a guarantee, okay, we're not relying on investment performance here in order to save on taxes. We know that if we take certain measures on the tax front, we will guarantee tax savings. Okay. And for this reason, I think it's the number 1 thing that a retirement planner should be doing for you. Okay. If you go to your advisor, your financial advisor, your retirement planner, whatever you call them, and you go, hey, I heard about this tax idea. Does it apply to my situation? Or, hey, I'm looking to pull $30,000 from my accounts. Which accounts should I pull them from? And they go, I don't know. Talk to your CPA. We're not a tax professional. I would recommend searching for a different advisor. The reason being is because tax planning is that critical. Okay. It's something that I would argue it's a necessity if you're in retirement looking for an advisor. So just keep that in mind as we go through here. Now, we've talked about this too on different presentations, but we developed this Social Security Millionaire framework. And the idea behind it is that every retiree, or the average retiree, can turn their Social Security benefit into $1 million asset if they take the right measures. Okay. Now, unfortunately, most people stop at this first point in this framework here: when to file. Should I file at 62 or 70? And how much benefit do I get based on when I file? When's the break even based on, if I take it early and invest it, when's that break even? Okay. And they're missing the ball when they're just looking at the monthly benefit. Because as with everything in retirement, we need to look at every decision through these next 2 lenses: the tax effect, which is how much of your benefit do you actually keep? That's what we're going to be talking about today. And number 3 would be coordination with your other assets. Okay. How can we coordinate our Social Security benefit, in with our other assets, so it's all working as a team to meet the goals that we have? Okay. And so again, don't stop, just look at Social Security through that first lens. Look through it both on the tax effect and then the coordination of other assets. And I think the optimal Social Security strategy will become much more clear when you look at it through this comprehensive way. Okay. So just kind of basics. If your full retirement age is 66, meaning that's the age that based on when you were born, this is the age you are able to receive full unreduced benefits. For every year that you file early, you get penalized for doing so. Okay. So if you file as early as 62, you get a 25% reduction in benefits. If you delay all the way to 70, you get an 8% step up for every year that you delay. Now, especially in today's economic climate, how valuable is an 8% step up? Okay. Are there any 8% CDs out there that maybe I don't know about? Of course there are. Okay. So an 8% guaranteed step up is a huge benefit, especially in today's climate. But it's important to note that filing at 62 versus 70 is a 76% difference in monthly benefits. So this is a huge amount. And just remember this when we're talking about taxes. Okay. So just some kind of Social Security basics. Okay. When Social Security was first put into law. The opening pamphlet said Social Security isn't taxed and will never be taxed. Okay, well, hopefully nobody trusted the government fully, because a few decades later, they changed the code, and now Social Security is taxable anywhere from 0% to 85%, which is a huge margin if you think about it. Okay, you could have if you have $50,000, you and your wife have $50,000 covered from Social Security. It could be anywhere from completely tax-free, treated as if it was a withdrawal from a Roth, or it could be treated as much as 85% of that is taxed. And so that's a huge wide gap. And obviously, the closer we can keep to zero, the more we're going to have in ongoing savings. So in this wide gap, how is it determined? How much of your benefit will actually be taxed? Well, it's determined with this formula called provisional income. And we'll walk through an example of what that looks like in a sec. But it's important to note that everyone is on an even playing field when it comes to Social Security taxation. What I mean by that is it doesn't matter if you have $100,000 in IRA asset or in retirement assets, or $5 million. Okay. A person with $100,000 could be taxed at 85%. A person with $5 million could have a Social Security benefit that's tax-free. Okay, so it doesn't matter how wealthy you are. Everyone is taxed based on the same formula. There's no means testing. There's no tricks. Okay, and so we can see that the more you have in retirement savings, when you're pulling from other assets, typically going to be the higher your tax rate is. Well, when we talk about Social Security, again, everybody's on this equal playing field. So I make the case that the more you have in retirement savings, the more valuable Social Security is for your situation. And again, it comes down to taxes. Okay. So there are 13 states right now that tax Social Security benefits. Our home state of Wisconsin is not one of those, luckily. Okay. So keep in mind that if you're planning on moving to another state, move to a state in retirement that does not tax Social Security benefits. Again, if you have a $50,000 coming from Social Security in Wisconsin, you might pay some federal income tax. Anywhere from 0 to 85% of your benefit might be taxable, but you won't pay any state tax on that Social Security benefit. Okay. So what is provisional income? What is that formula that determines taxation? Well, the formula is up on the screen right now. You see it's your adjusted gross income. So that would be things like annuity payments, pension payments, IRA withdrawals. Okay. Plus tax exempt income. So things like muni bond interest gets added back into this equation. And then 50% of your Social Security benefit. Okay. And again, just to kind of simplify it, the lower your provisional income is, the lower your taxes will be. Okay. So we want to keep this provisional income essentially as low as possible. Okay. To keep our Social Security benefit as taxed as least as possible. Okay. So if we just look at this equation, okay, what is the hidden secret in this equation? Okay, well, let's step through it. Okay, any IRA withdrawals, any pensions, any annuity income is going to be treated dollar for dollar in this equation. Okay, all tax exempt income is going to be treated dollar for dollar. Okay, but notice that when we look at your Social Security benefit, only 50% of your benefit is counted in this equation. Okay, so everything else is treated dollar for dollar. Every dollar of your Social Security benefit, there's only 50 cents is counted in this equation. So the hidden secret is the more, the bigger Social Security benefit that you have, that you and your spouse have, or that you have, the lower your provisional income will be. Okay, if we need $80,000 of income, okay, in a given year, if we had $80,000 of Social Security benefit, our provisional income would be $40,000. That's as small as it could theoretically be. Okay. If we had only $10,000 of Social Security benefit and $70,000 was coming from our adjusted gross income, we'd have a provisional income of $75,000 because again, 50% of the Social Security benefit. And so basically my case here is that the more you have coming from Social Security, the lower this provisional income will be. And then remember, the lower this provisional income, the smaller you will owe, or the less you will owe in taxes. Okay. So once you have your provisional income, you plug it into this table. Okay. So for a single person, you can see on that top row, less than 25,000, your benefit's completely tax-free. Between 25 and 34,000, it's up to 50% of your benefit. And more than 34,000, up to 85% of your benefit is taxable. Okay, so again, this table alone still confuses people. So I'm going to walk through screen share and kind of walk through an example of what this will look like. Let me just get my iPad out. Try to screen share here. Hopefully it'll work. Trying a new technique, trying to write some stuff out for you guys right in front of you. All right. Okay, should be able to see my screen of a whiteboard, hopefully. Oh, perfect. Okay, sweet. Okay, so let's say we have someone who's single, okay, and they're taking, let's say, $20,000 from their IRAs, and they're taking $20,000 from Social Security. Okay, so they have a $40,000 retirement income. So if we're going to find our provisional income here, we remember that we take a dollar for dollar every dollar of withdrawals that come from IRAs. Okay, so the first part of this equation, we would have $20,000 coming from IRAs. In this example, we don't have any tax exempt income. Okay, so that's a zero. And then we take 50% of your Social Security benefit. So in this case, again, that would be 10,000. And we would get a provisional income of 30,000. Okay, that's pretty simple, but how does it plug into this table then? Okay, so again, if you're single, the first 25,000 of provisional income is essentially tax-free. Now, most people think that once you go over this $25,000 mark, instantly 50% of your benefit becomes taxable. Okay, but that's not actually how it works. It's within this range, 50% becomes taxable. Okay, so we know at a $30,000 provisional income, we are in this range. Okay, so we would take $30,000, we would subtract out 25,000, which would give us 5,000 in this range. And we owe 50% of the benefit in this range becomes taxable. Okay, so we divide that by 2. And even though we have a Social Security benefit that's $20,000, only $2,500 of it becomes taxable. Okay, so just that money in that range becomes taxable. Let's go through another example even further. Let's say we have someone who's married and they have $30,000 coming from their IRAs. Okay, and they have $50,000 of a Social Security benefit. So once again, plug this into that provisional income formula. We'd have $30,000 here. Again, no tax exempt income. And then we're going to add in half of the Social Security benefit. Okay, so again, that would be $25,000. And we get a $55,000 provisional income number. Okay, now if we just scroll back up here, okay, we are not only over this 50% range, we're in the 85% range. Okay, so basically from 32,000 to 44,000, we are fully subject to that tax range in that range. Okay, so there's a $12,000 range there from, again, 32,000 to 44,000. Okay, so in that range, 50% taxable, we would owe 6,000 of our Social Security benefit. But then we have a $55,000 provisional income, which again will be greater than that top end range. So above 44,000, 85% of our benefit becomes taxable. So 55,000 is $11,000 more than 44,000. So we times that by 85%, and I'm just going to have to do that quick on my calculator. That would be 9,350. And so we would owe, or the amount of our Social Security that would be taxable would be $15,350. Okay, so even though we're taking $50,000 from Social Security, we have an income of $80,000. Okay, only $15,350 of our Social Security benefit ends up becoming taxable. Okay. Oh, not seeing the whiteboard. My apologies, guys. Resume sharing. Okay, my apologies, guys. Let me walk back through that. Okay, so we have a single person, $20,000 coming from IRAs, $20,000 coming from Social Security. Okay, that means that they would have a provisional, or so they would be taking a total retirement income of $40,000. Okay, so if we plug this into the provisional income table, $20,000 coming from our IRAs, okay, that's dollar for dollar, plus $0, we don't have tax exempt income, plus half of the Social Security benefit, okay, which would be $10,000. That would give us a $30,000 provisional income. Okay, now remember, this is single, so if we plug this back into the equation here, we are going to, at $30,000 of provisional income, we are going to be in this range here. Okay, which means that 50% of the amount in this range is going to become taxable. So if we take $30,000 of provisional income minus the bottom end of this range, which would be $25,000, we have $5,000 in this range. $5,000, again, 50% of this range would then become taxable. So we take 5,000 divided by 2, that gives us $2,500. So even though this person is taking $40,000 of retirement income, only $2,500 of their Social Security benefit will become taxable. Okay, let's go through a married example. Okay, so again, just to step back a sec, just to note, again, it's just the amount of money in these ranges becomes taxable. So in the 25 to 34,000, 50% of the money in that range becomes taxable. Above 34,000, 85% becomes taxable. Okay, let's go through a married example with a little bit more money. $30,000 of IRAs, $50,000 of Social Security. Again, we plug that back into this provisional income. We take $30,000 plus half of the Social Security benefit, which would be $25,000, which gives us a provisional income of $55,000. Okay, now $55,000 is greater than this range and it's greater than this. Okay, so we're going to be fully taxable in this range up to 50%. So there's $12,000 in that range. We're 50% of $12,000 is going to become taxable in this range. That gives us 12,000 times 50% gives us $6,000. Okay, then we scroll back up. $55,000 is more than 44,000 by $11,000. Okay, so 85% of $11,000 is going to become taxable as well, which would be $9,350. This would mean that we add those together, $15,350 of our Social Security benefit is going to become taxable. So if we add that back in to our IRAs to give us our actual taxable income, we would have $45,350. Again, if this is a married couple and they're both above 65, the standard deduction is going to be 27,000 and some. So they're really only going to have a taxable income of, less than half of that. Okay. So let's screen share back into this whiteboard or this presentation. Sorry about that, guys. I did not see your comments. So I was just droning on for a little bit there. Anyway, so that's basically how you figure out taxes on your Social Security benefit. So again, if we step back, the more that you have coming from Social Security, the less you will owe in taxes because of this provisional income. So as you can see, even though this person with that last example, they were taking $50,000 of Social Security benefit, only 15,000 of it was actually taxable. Okay. So about 30% of their benefit was taxable in that example. So as you move through retirement, there are essentially two ways that you can help save on taxes. Okay, and it's doing things before you filed for Social Security and then doing things after you filed for Social Security. let's go through the before you filed first. Okay. So again, most people look at delaying their Social Security benefit as a sacrifice. Okay. If I delay my benefit, my income is going to have to come from somewhere. Okay. And so that income is going to have to come from my retirement savings, which means my retirement savings are going to get smaller. So I own my retirement savings. I don't really own my Social Security benefit, especially after I die, I don't own it. So I'd rather retain the retirement savings. What I want to show you is that delaying Social Security isn't a sacrifice in a lot of cases. It's actually an advantage. Okay, so where does the average retiree hold the majority of their retirement nest egg? I've already got the answer. It's tax deferred accounts on average. And this makes sense because as you're working, you're typically in a higher tax bracket. And so you get a tax deduction for contributing to 401ks, for contributing to traditional IRAs. And so a lot of people just squirrel away money in these tax deferred accounts. And again, while you're working, this makes quite a bit of sense. Once you retire, this can be a huge liability. Why? Well, because of this thing called required minimum distributions. Okay. So once you turn 72, the government has given you a tax break when you contributed to these accounts. At some point, they want their taxes back out. Okay, if there were no RMDs, you'd be able to essentially defer taxes for generations. The IRS wants to avoid that, so they implement RMDs. And so we've shared examples like this in previous presentations, but let's say a couple ended 2020 with an IRA balance of almost $900,000. They're turning 72 in 2021. Okay, so their estimated RMD is $35,000. Now, let's say this RMD is above their income need. Okay, so prior to taking RMDs, their Social Security benefit, maybe a pension, fulfilled their entire income. And so this $35,000 is just income they don't need, but are yet forced to take. Well, they're taxed on that RMD at normal federal rates. They're taxed on the additional Social Security that becomes taxable because remember, that $35,000 is going to be added to their provisional income, which is going to raise the amount of Social Security that ends up becoming taxable. So in total, just looking at federal taxes, this isn't even looking at state taxes, they're going to owe $11,600 of that $35,000 RMD to taxes, okay, which is a 33% tax rate. Now, if we just add in state taxes, that's probably closer to a 40% tax rate. Okay. And so this $35,000 RMD, they are going to retain less than $24,000 of it because they're losing all of this to taxes. So what I see often is people filing for Social Security as soon as they retire. And it feels really good for those first 8 to 10 years. And then they get hit with RMDs. And it is incredibly difficult once RMDs start to minimize these RMDs. So can we turn delaying Social Security into an advantage? And yes, okay, let's take an example. Let's say somebody's got $750,000, 580,000 of that is in tax deferred accounts. And so when they walk into our office, they say, I'm going to retire and file for Social Security immediately. So I'm not withdrawing from my assets. And this feels, again, very good for those first couple of years. You see this blue line here is Social Security on the bottom here. It is green are RMDs. And so you see filing right away keeps their distribution small at the beginning of their retirement. Okay. But after RMDs begin and they're forced to take money from their retirement, you see it rises above their income need. Okay. And in total, throughout their retirement, we estimated they would owe $276,000 in taxes. So by delaying Social Security, can they avoid this situation? Okay. And the answer is yes. Okay. Prior to filing for Social Security, use some of those 401k and IRA assets. Okay. Yes, that will deplete your assets a little bit in the short term, but remember, we're not living a 5 to 10 year retirement. You're living a 20, 30, potentially 40-year retirement. And so we need to losing money or depleting your assets for the first couple of years in order to save over the rest of your life can make a lot of sense. Okay, so they're using IRA assets over here. Notice what happens to the RMDs later. They stay below their income need, which means that they're not wasting income on extra taxes. Okay, that RMD isn't going above their income need, and so they're not wasting. It's not inefficient income essentially. And during this time period, they could also implement Roth conversions as well, so that those Roth conversions, because they don't have this huge income need later in retirement, those Roths might be able to grow unencumbered. And so yes, they're sacrificing a little bit in the short term in order to get the 2 marshmallows later, okay, and let their assets grow unencumbered for the long term. Okay, and you see there's over $170,000 in tax savings, just again, by delaying Social Security and turning that delaying into an advantage. Now, it's important to note too, when you are retired, when you file for Social Security, I shouldn't say when you're retired, when you file for Social Security, you lose out on some important tax planning strategies. Okay, and it's not that they're necessarily taken away as much as they become significantly less valuable. And what are one of those strategies? Roth conversions. Okay, why do Roth conversions become less valuable once you're on Social Security? Well, when you do a Roth conversion, you are essentially taking money from your IRAs, paying taxes on it now. You're taking it as taxable income in a way and converting it to a Roth in order to never pay taxes again. Well, every dollar that you convert is included in provisional income. And so it raises the Social Security, the taxability, it raises the amount of your Social Security that will become taxable. Okay, so once you're on Social Security, Roth conversions are still possible in certain situations and still make sense in certain situations, but they become significantly less valuable. And so on the screen right now, I just have someone's tax situation with this yellow line, these yellow bars at the beginning are Roth conversions. The bright blue is Social Security, and then the green are going to basically be RMDs. Okay, so prior to having no Roth conversions, you would see these person's RMDs push them up into this purple line, which would be the 24% tax bracket. Okay, and so in this situation, we had them implement 6 Roth conversions at the beginning of retirement. Still, even once they filed for Social Security, we had them do a few Roth conversions, but see what happens to these RMDs. They stick in the 22% bracket, so they're not pushing this person into the next bracket. And I believe there's still Roth conversions to be had even on top of this. But as you can see, just kind of a quick analysis, it would have saved them $236,000. So again, while you're delaying Social Security, not only take from those IRAs, but implement some Roth conversions given, depending on your situation, if you have huge tax deferred balances, okay? And in that way, you're turning delaying into that advantage. Okay. So again, general strategy, delay claiming until later while using qualified accounts. 2 things happen. One is your Social Security gets bumped up by 8% a year for every year that you delay. And we know that the larger your Social Security benefit is, the easier it will be to save on taxes over the long term. Okay. Delaying and using those qualified accounts will help lower RMDs. And then once you're at age 70, hopefully we've eliminated a ton of those IRA and tax deferred balances. And then from there, you can use taxable accounts. You can use Roth accounts in order to keep your Social Security benefit as tax-free as possible after age 70. Okay. So again, just a general strategy. So after you filed, what can you do? Well, Social Security is anywhere from 0 to 85% taxable. In my experience, retirees greatly underestimate how close they can get to 0% taxability with the right plan. And we've kind of already alluded to that, right? Okay, if you're using up those qualified accounts or converting those to Roth, and you delay to 70, and at 70, your situation looks like you have a ton of income coming from Social Security, and the majority of your other investments are in Roth accounts or taxable accounts. Okay, you are essentially going to be as close to the 0% taxable bracket, if not 0%, as possible. And remember, the bigger your Social Security check is, the less you will pay in taxes. It's that simple. Okay, so let's look at a quick real world example. Let's say you needed $95,000 of income in 2020. Okay, and let's say you had no Social Security benefits, so everything was coming from your IRAs. Which means everything would be taxable. This is for a married couple. You would owe almost $8,000 in taxes. Okay. Now, if you file at 62, you had a smaller benefit because of filing at 62. So your benefit was only $37,000. The rest would come from IRAs. Your taxes would look like you would owe $7,380. Okay. If you delayed to 70, your benefit would be as high as $65,000. Only $30,000 would come from IRAs. And notice what happens to your tax bill. Okay. It is a third of the other tax bills, just about. Okay. So your tax is lower by essentially 65% from the other scenario. So again, the more you have coming from Social Security, the lower your taxes will be. But how can we plan and benefit beyond just delaying? Okay. Invariably, not everybody is going to be able to delay their benefit and clear out their tax deferred balances. So when you are withdrawing from tax deferred balances after Social Security, how can you make sure that you save as much as possible on taxes? Okay. Well, for those that don't know, and I'm just going to get my my writing tool here. Okay, this is what we refer to as essentially your retirement tax brackets. So once you file for Social Security, your tax brackets will completely change. Okay, the normal tax brackets are here in blue down below at 0% under the standard deduction. Then it goes to 10, then 12, then 22, then and so on. Okay. Now, when you file for Social Security, there's a range that opens up that as your provisional income rises higher, it causes more of your Social Security benefit to become taxable. So essentially every dollar you take from your IRAs you're taxed on that dollar, and you're also taxed on the amount that it moves of Social Security into being taxable. So essentially you become double taxed, and it creates this red line here. Okay. Essentially, this is called the Social Security tax torpedo. It's called the Social Security tax trap. And as you'll see, it raises your tax rates by 50 to 85% across the board. Now it ends once your Social Security becomes fully taxable. Okay. But what I want to point out right now is the high point of this tax trap. Okay. And this is basically when you're in the 22% bracket and your Social Security benefit isn't fully taxable. And the more money that you take from IRAs, from pensions, from annuities, causes 85% of your Social Security benefit to become taxable as well. And it raises your marginal tax bracket to 40.7%. Okay, so why does this matter in retirement? Well, depending on where your income falls in a given year, will change which accounts you want to withdraw from for your income need. Okay, so let's say that we find ourselves right on this border right here. Okay. And let's say we need $10,000 more for whatever retirement income need that you have, for traveling, for whatever. Well, if we take $10,000 more, we're going to be somewhere in here. Okay. Which means that of that $10,000 that you take, you're going to lose 4,070 of it to taxes. Okay, because that's your marginal tax bracket. So if you really actually want 10,000, you're going to need to take far more than 10,000 in order to take the 10,000 net and also pay the taxes. So in fact, you might have to take over here, this much over here. And so what other options do you have? Well, let's say you're right over here again. And you know that the 40.7% tax bracket is right on the other side. If you take more income from IRAs, you're going to be subject to 40.7. Okay, well, take from IRAs instead. Okay, take from a taxable account instead, and avoid a large amount of this. If you take all from Roth, you essentially wouldn't push your taxable income further up. Roth IRA distributions are not treated or are not counted in the provisional income. Okay. So for instance, okay, we can go through an example like this. Let's say you're taking $35,000 from your IRAs. So again, you're right on the border here. You need $5,000 extra of income, and you're in the 22% tax bracket. So what is this person's tax rate on the extra $5,000? Well, they're going to be taxed at 22% on the $5,000. This is intuitive. Most people get this part of it. Okay. They take money, they're taxed at normal federal income rates. But that $5,000 also moves, let's see, it would be $4,250 of your Social Security benefit into being taxed at that 22% rate as well. Okay, so essentially you're double taxed, as we were talking about. This is how this tax trap is created. And you're going to owe 40.7 on that extra $5,000. Okay, so even when you're on Social Security, there is still tax planning that needs to be done on an ongoing basis. And you need to be strategic about where your withdrawals come from. Okay, now it's important to note everybody's tax trap, everybody's tax torpedo. This graph right here is going to look different for everybody based on what your Social Security benefit is, what it looks like. Okay. And again, your income will be different too. You might be over here, in fact, in the 0% bracket, and you need to take $10,000 more, and it's going to push you somewhere over here. Well, once again, if we can avoid this, if we can avoid this double taxation in this zone right here, and in this zone right here, okay, we should do so at all costs, okay, because it will raise our marginal rate. Okay, so general strategy for after filing. Again, we've talked about delay claiming until later to maximize the tax preferential income. You want as much income coming from Social Security as possible, just based on the formula that will keep your taxes lower. While delaying, use tax strategies to ensure that tax deferred assets are as small as economically possible. Okay, and then finally, where the real added tax benefit comes from is knowing your annual tax bracket, your annual tax table. I can't stress how important this is. I can't stress how often I see advisors and retirees not looking at their annual tax bracket. Okay. Unfortunately, there's even CPAs that we've talked to that don't understand this tax trap and how it's created. And so they even might tell you to take from IRA assets, when in fact, that's the exact wrong move. Okay. So if you're on the cusp of the Social Security tax trap or tax torpedo, you want to fill in additional income from other places, not IRAs. And again, that'll keep you out of the heart of that tax torpedo. And really what we're avoiding there is that 40.7. It's important to note too, that tax torpedo will get even higher after 2025 because the Tax Cuts and Jobs Act is expiring. And so once that happens, that 40.7% part of the bracket now becomes 46.25%. Okay. So in summary, don't underestimate the power of Social Security. And again, I don't mean just from a standpoint of, oh, it's a nice monthly benefit that you've paid into, and now you finally get, some benefit from now that you're retired. I mean, don't underestimate the tax savings that Social Security can provide. The more you have in assets, the more valuable Social Security becomes. It's as simple as that. It's again, I've seen this essentially maximizing Social Security, both from a benefit standpoint and tax standpoint, change retirements. Okay, take somebody from a 60% probability of success up into the 80s. Okay, and so it can make a huge difference depending on your situation. So don't underestimate Social Security. And then maximize tax savings from Social Security involves both strategies before and after you retire, or before and after you file. Okay. And so let me know if you guys have any other questions. I'm not seeing too many come through. Sorry about that technical issue with the whiteboard in the middle of this presentation. Always remember, guys, you don't need more money. You need a better plan. You need to get the most out of Social Security. And when I say you need the most out of Social Security, it means you need to retain the most. Okay, I don't want you guys, giving hard money that you've already paid taxes on. You've already paid taxes and paid into the Social Security system. And I don't want to see you taxed a ton once you're taking that money out. Okay, I want this money to stay in your retirement, out of the IRS's hands. So hopefully this was informational. Let us know if you have any questions afterwards, and look forward to the next Wealth Wednesday. Thanks a lot, guys. Stop sharing this. Have a good one, everyone.